Hi, I'm Chuck Else with Osborn Partners Capital Management. The investment world can be a complex place for many investors to understand. We often find that many investors don't really understand the fees they are paying for wealth management. This can be particularly true with investors who own mutual funds or are working with an advisor who invests them with outside managers, with separately managed accounts, or in illiquid investment products such as hedge funds, private equity funds, structured notes, and annuities. Today, I'd like to discuss these layers of fees and the impact they have on your long-term returns. I'll also provide you some questions to ask your current advisor. One of the greatest drawbacks of mutual funds, outside managers, separately managed accounts, or illiquid investment products are layers of fees you may not be aware you're paying. If you are working with an advisor, you are paying the advisor their fee. In addition, you are paying fees in mutual funds, to outside managers, or embedded in other investment products. With mutual funds, you are also paying transaction costs anytime the manager of that fund buys or sells securities, and those costs are not reported to you. You may also be paying a number of fees for the sale and distribution of mutual funds, including 12b-1 fees, redemption fees, and front-end or back-end loads. And over time, fees really have an impact on your investment success. Consider the following example. This chart shows two hypothetical investors over a 20-year time frame. Investor A is working with an advisor who owns individual securities instead of mutual funds or other products and pays an advisory fee of 1% per year. Investor B is working with an advisor who invests in mutual funds, outside managers, and other products, and is paying an advisory fee of 1% per year, plus additional fees of 1.5% per year. And we assume both investors are receiving a return of 9% before fees. Now look at the difference in how their money grows over time. Each starting with $500,000, investor A ends up with more than an additional $500,000 than investor B over the 20 years. So here are some questions you should ask your advisor. First, what is the advisory fee I am paying you? Also, what are the fees for any funds, outside managers, or other products in my portfolio? And finally, what are the total fees I'm paying for your management of my portfolio? Many investors who ask these important questions find they are paying way more in fees than they realized. In analyzing the portfolios of new clients to our firm, I regularly see people who are paying 1.5% to 2% per year. Fees matter. It's important you know what you're paying. Now, a little bit about our firm. We're one of the oldest firms in the country, having been established in 1937 in San Francisco. We manage approximately $1.6 billion in total assets, and we invest in individual securities, removing the additional layer of fees associated with investing in mutual funds, outside managers, separately managed accounts, or other investment products. If you'd like to receive our white paper discussing these topics in greater detail, or if you'd like to reduce your fees and improve your investment results, please contact us. You can email us at info@osbornpartners.com or call us directly at 1-800-362-7734. Thank you very much for watching today.